This is the Southside School of Financial Freedom Watchlist and Market Report for the week ending June 4th, 2022. Our question this week is, what is quantitative tightening? The answer will be provided later in the video. This week, the market ended lower. The Dow Jones Industrial Average decreased minus 1.05% on Friday and was down minus 0.94% for the week. The S&P 500 decreased minus 1.63% on Friday and was down minus 1.2% for the week. The Nasdaq decreased minus 2.47% on Friday and was down minus 0.98% for the week. Looking at the week, we can see that there were 9 down finishes versus 3 up finishes for the major indexes. On Monday, the market was closed. On Tuesday and Wednesday, all the major indexes finished down. On Thursday, they all finished up, and on Friday, they all finished down again. The new unemployment claims were 200,000 versus 210,000 expected. It was reported that May payrolls rose by 390,000, but private payrolls increased by just 128,000. Home prices surged over 20%, it was reported in March. Last week, mortgage rates rose sharply. The 30-year fix hit 5.47%. Mortgage demand, however, fell 1%. And oil prices jumped after EU leaders agreed to a ban on most Russian oil imports. New unemployment claims, overall payrolls rising, private payrolls increasing, home prices surging, mortgage rates rising, mortgage demand falling, and oil prices jumping are all news. And news drives the market, good and bad. Day-to-day predictions on whether the market is going to go up or down is virtually impossible because predicting the news is impossible. However, the market is rigged to go up. It does not go up every day or even every week, but the market will generally go up over time. Stock prices move in a random fashion. They go up and down with an upward drift. The market will continue to go up because the powers that be want the market to go up. While there are many powers out there, the top 5 powers that be are the Federal Reserve, big financial institutions, big corporations, the President, and Congress. These 5 entities will do what they must to drive the market higher. Now, we are at our question of the week. What is quantitative tightening? Quantitative tightening is the opposite of quantitative easing. And since quantitative easing is the expansion of the Federal Reserve's balance sheet, then quantitative tightening is the reduction of the Federal Reserve's balance sheet. The Fed's balance sheet consists of the financial securities that the Federal Reserve has purchased and maintains. The Fed's purchase of bonds and other securities is a monetary policy strategy that expands its balance sheet. When the Fed uses money that it creates to make bond and other security purchases, it expands or eases the money supply. In contrast, the Fed reduces or tightens the money supply by selling previously purchased bonds and other securities and or letting them mature without replacing them. This quantitative tightening is a contractionary monetary policy, and it is the reverse of quantitative easing. Quantitative tightening, or QT, could possibly impact the financial markets. QE, or quantitative easing, often causes stock prices to go up. So, QT may possibly cause stock prices to go down. What do you think? Are your stocks affected by QT? Or do you own any stocks at all? If not, why not? Is it because you do not understand anything about the stock market? Well, it was not taught to you in school. However, if you ever want to learn how to get wealth and income through the stock market, you are going to have to teach yourself. You must RSI. That is, read, save, and invest. Formal school taught you how to read, but society and the powers that be discourages you from reading, especially books. School taught you to be a worker, they did not teach you how to be an investor. And they taught you absolutely nothing about the U.S. financial system. You can learn how to be an investor if you simply start reading books about investing. Books that you can borrow from the library for free or buy cheaply online. It is not difficult to learn how to be a passive investor, which is what most people should do. Check out this list of recommended books on the books page of the Southside website. These books and others like them will not tell you which direction the market is going to go, but you can learn how to make money in the market no matter what the market does. I don't know which way the market is going to go on a daily basis, and I don't care. I trade the market as it is, not as it should be. I take what the market gives me, whether it's going up, down, or even sideways. How do I do that? I apply the Southside strategy. You can learn more about the Southside trading strategy at southsideschooloffinancialfreedom.com. Here is the Southside Trading Watch List from the week ending June 4th, 2022. I trade at least 3 of the stocks on the list every week. The strongest performer on the list this week was Datadog Incorporated, ticker symbol DDOG. It's in the third column. It increased 7.52% for the week, but was down minus 4.22% on Friday. Datadog Incorporated provides monitoring and analytics platform for developers, information technology operations teams, and business users in the cloud age. The company's software as a service platform integrates and automates infrastructure monitoring, application performance monitoring, log management, and security monitoring to provide real-time observability of its customers' technology stack. Looking at a summary of results, you can see that Datadog has decreased almost 41% year to date. I did not trade Datadog this week, but I have traded it in the past. Whether a stock goes up or down, you can generate cash flow from it. Whether you own a stock or not, you can still generate cash flow from it using the Southside strategy. The Southside trading strategy involves trading for weekly cash flow, that is, trading for income. SPY is shown at the bottom of the third column. SPY is the S&P 500 ETF. This is the benchmark I compare my trading performance to. My objective is to beat the S&P 500 index while at the same time generating cash flow. Most professional money managers do not consistently outperform the S&P 500 index. They usually lose and lose badly to the index. Thus, most investors and traders should just invest in or trade a market index fund or ETF like SPY. What do you do? Do you beat the S&P 500 index? Do you have a watch list? What is your investing and or trading strategy? How well do you do against the S&P 500 index, ETF, SPY? Let me know in the comments section. Are you willing to share your strategy? The Southside portfolio is not outperforming the S&P 500 index, ETF, SPY. The Southside portfolio is down minus 38.26% versus minus 13.56% down for SPY, a difference of 24.7%. The Southside is losing to SPY by almost 25%. The primary reason the portfolio is losing is that the Southside is heavily invested in Bitcoin, and Bitcoin is in a deep bear market. Will it bounce back this year? Stay tuned to find out what happens to Bitcoin and subsequently what happens to the Southside portfolio, because we will remain heavily invested in Bitcoin. The portfolio is 87.03% in a Bitcoin trust. Equities, including puts, calls, and ETFs, make up 11.86% of the portfolio. Cash is 1.11%. The cash flow generated for this week was 0.73% of the portfolio account value. The account value changed by 0.62%. Meanwhile, The S&P 500 ETF SPY changed by minus 1.14%. I sold option contracts on 2 positions this week, 1 call and 1 put. That ranged from $146.70 to $213.38. You can get more details, including the total dollar amount of cash flow for the week, on the website southsideschooloffinancialfreedom.com. Check out past videos for other questions of the week. They are listed in the description section. In the meanwhile, please like, share, and subscribe.